Right now, everyone is distracted watching tech stocks go vertical and chasing the AI hype. But while they weren't looking, the so-called adult in the room, the bond market, quietly pulled the plug on the party. The 30-year Treasury yield recently spiked to its highest level since 2007. To understand why that single number is flashing a massive warning signal for the economy, we have to look at the underlying mechanics of the debt market. This animated seesaw mechanism illustrates exactly how a bond works. A bond is essentially just an IOU issued to buyers. The relationship between those buyers and the bond is strictly inverse. If buyers pull back and demand wanes, the price of the bond drops on one side, which mechanically forces the yield percentage upward on the opposite side. Price down, yield up. And right now, 4 specific macroeconomic weights are pounding the price side downward. The Federal Reserve raised baseline rates. Persistent inflation is eroding future returns. The U.S. is issuing Costco-sized amounts of new debt, and foreign buyers are pulling back. Together, these force the yield side higher as lenders demand a better return before locking up their money. This isn't isolated to the United States. Sovereign bond yields in the UK and Germany are sitting at multi-decade highs. Even Japan's 30-year yield reached an all-time high. The 30-year yield prices in 3 decades of inflation, deficits, and fiscal decisions. It is the ultimate test of faith in a nation's long-term financial future. And right now, global buyers are demanding a massive premium before they extend that trust. Yet, if you look at the players operating inside the $2 trillion credit market, they will tell you everything is perfectly healthy and completely under control. Those two realities cannot coexist. The damage from rapidly rising yields is building just underneath the surface, creating structural cracks that are getting harder to ignore. This lack of transparency is a structural feature of the market. By keeping these transactions private and valuations internal, the industry has built a firewall between these rising risks and the public eye. To map out exactly where the real pain is hitting, we have to move from the 30-year bond down to the short-term reality of the Secured Overnight Financing Rate, or SOFR. You can think of SOFR as the overnight receipt for the entire U.S. financial system. This chart maps SOFR's trajectory. In 2022, it sat near zero. By mid-2023, it aggressively spiked over 5%. This upward move is dangerous for floating rate debt, which is pegged to a benchmark. As SOFR rises, the borrower's cash interest payment expands in tandem, which brings us downstream to private credit. This is an opaque middle-market lending space designed for companies that are too large for a local bank loan, but too small to issue public bonds on Wall Street. Private credit loans carry 2 critical characteristics right now. They do not trade publicly, and the vast majority of them are floating rate. Take the software company Pluralsight. They were acquired using a massive private credit loan when SOFR was near zero. But when that rate shocked to 5%, their interest payments became unsustainable. To survive, they were forced to hand over 85% of the company to their lenders. Pluralsight is just one borrower in a massive stack. Nearly every corporate borrower relying on private credit has absorbed the exact same compounding rate shock. Default rates tracked by Fitch are hitting record highs. So how is the broader industry hiding the damage? In a recent earnings call, JP Morgan CEO Jamie Dimon noted that when you see one cockroach, there are probably more. The industry's mechanism for managing these defaults is a creative accounting feature known as the Payment in Kind, or PIK, feature. This flowchart shows exactly how a PIK loan operates. When a borrower cannot afford skyrocketing interest, the lender offers the option to pay in kind. Instead of triggering a default, the missed cash payment is rerouted and added directly to the growing principal balance. This becomes particularly significant when you factor in business development companies, or BDCs. These are investment vehicles that enjoy zero corporate income tax, but in exchange, they are legally required to distribute at least 90% of their taxable income back to investors. Because BDCs report that unpaid capitalized PIK interest as actual income, they are forced to mail out cash dividends to their investors based on money they never actually collected. This accounting structure allows lenders to categorize insolvent companies as healthy, income-generating assets on their official balance sheets, reporting growth even when no cash is actually changing hands. This practice is spreading. PIK features have jumped 72% since 2021, and for some funds, they now account for up to 14.5% of their total income. Because these loans don't trade on any public exchanges, they fall under a financial reporting category called Level 3 accounting. This means their official valuations are based entirely on subjective internal models, rather than observable market reality. But external data exposes those models. Recent analysis by MSCI found that behind closed doors, over 10% of these private credit loans are already marked down by at least 50 cents on the dollar. This chart visualizes the incoming climax of this crisis, the private credit maturity wall. It shows a massive, towering spike of $85 billion in BDC debt obligations, heavily concentrated straight into the years 2026 through 2029. Losses can be parked in accounting lines, and unpaid interest can be rolled into a bigger principal balance. But the cold math does not change. When these borrowers hit that maturity wall and are forced to refinance their near-zero debt at today's rates, the illusion ends.